Welcome to Sense and Sensibility, the Inflation Guy podcast. I am Michael Ashton. I am the Inflation Guy. I am your host. And today on the podcast, we're going to have a little bit of fun with a theoretical question that was really actually a lot of fun to play with. You know, it's a lot of times when you just asking those questions that maybe on the surface seem very simple, but they kind of force us to really get deeper and deeper. Well, what if this? Well, then that would cause this. Well, then what are the implications of that? And then working that all the way through sometimes leads us to insights that we don't have if we just sort of take sort of the standard line about why things are and why they should be. So asking these questions is really quite important. And so we have a very important question today that was posed by a reader, and I had a lot of fun with it. But before we get into that, I'm going to first thank our sponsors and then get into my weekly gripe. First, let's remind you that this episode of Sense and Sensibility is sponsored by Simplify ETFs, a fast-growing manager of liquid alternative ETFs. They really are fast-growing too, because I know because in my LinkedIn feed, I'm always seeing about people that are hiring. Simplify is bringing Wall Street to Main Street by providing access to institutional strategies perfect for diversifying your equity and bond portfolios previously only available to big institutions and the ultra-rich. Check out their website at simplify.us. You can find their entire lineup of ETFs at simplify.us/ETFs. And now my gripe, okay, which has nothing to do with Simplify, but my gripe. So, and this has nothing to do with inflation either. I've got a platform, and so I'm going to gripe. And I'm going to gripe about the utter lack of creativity that is out there when it comes to a lot of things, but lately we've seen it in politics. Now, lack of creativity in politics and in government is nothing new, obviously. I mean, government has been very uncreative for, generations. And so when you have somebody come in and upset the apple cart as Donald Trump has done, what I said at the top of this podcast about questioning sort of the fundamental assumptions and asking the questions and getting to the implications, politicians never do that. And it's really sort of interesting and refreshing to have a politician come in and upset the apple cart and make us rethink everything from first principles. But I'm amazed at the lack of creativity, and it's very frustrating when there's a proposal and the initial proposal makes you go, whoa, that just sounds crazy. And people stop thinking at that point. So I'll give you an example, one that happened over the last couple of weeks that, Donald Trump said, we're going to take over the Gaza Strip and, send all the Gazans away and, rebuild it. And then they can come back. And the predictable response was, that's crazy. There's 2.3 million or something residents in the Gaza Strip, and yes, right now it's a smoking hole. But we can't send all those people away. Where would they go? And so therefore, this can't happen. This is just stupid. Why would you even propose such a thing? You can't. That's a genocide. Okay. So maybe we can't send all 2.3 million of them out for 10 years. But what can we do? I mean, do we have to stop at that point? Hey, how about this? This took me all of 4 seconds to think of. Why don't we divide the Gaza Strip into little substrips and we can empty 1/10 of the Gaza Strip and rebuild that 1/10. And so that 230,000 Gazans, well, those maybe they can be distributed in other parts of the Gaza Strip, or they can go away for a while. And then in a year, when that part of the Gaza Strip is fixed, then those people come back and then we work on the next strip. In other words, we don't have to work on the whole dang thing all at once. Maybe we can work at it in pieces. So I'm not saying that's the right answer. I'm just saying that just because you don't like the initial proposal to just empty the Gaza Strip and go fix it, it doesn't mean you should stop thinking. Another example, the buyout that was provoked by Doge, offered to lots and lots of government employees that, essentially resignation in place, resign 9 months forward and you can collect your salary for 9 months but then you're no longer in the government. And the one of the complaints I saw was, well, what if the entire CIA takes the buyout? You have no CIA. Well, wait a minute. If the entire CIA takes the buyout, then you'll go rehire the people that you need to rehire from the CIA. I mean, it's what happens if in a particular company you offer a buyout, you have to offer it to everybody, and sometimes people take it that you don't want them to take it because they're the good ones. You just rehire those people. It's not like no one's ever done this before, so don't be moronic. And by the way, this isn't just the resistance. This isn't just Democrats saying, "Oh, we don't like Donald Trump, so let's come up with." This is people who like the policies and just don't seem to be creative at all. Don't seem to have any ideas, and so this is not just politics. Obviously, this is a theme. This could be a theme of this podcast, right? There's a great book entitled "Why Not" by Nalabuff and Ayers, and I'll put a link in the show notes, that just teaches different ways to turn a problem around in your head to find a solution. And it is astonishing to me when in just talking to people and reading things, how that skill just does not exist. It's amazing how few people can look at a problem and if they don't come up with the answer immediately, just give up and just move on to the next thing. And, or maybe they try one or two, standard things they've tried and it doesn't work. And so they walk away. I mean, if you're trying to fix something at home and it's got it's got a screw in it and it doesn't have, it's not a Phillips head or a flathead. It's got a weird shape. Okay, I'm done. Walk away. Well, yeah, there may be other ways to remove that screw. I mean, we can think about it a little bit, right? In the inflation world, in finance generally, we do this all the time, okay? We see a problem and we're like, okay, there's no really direct answer here. So let me think about different ways that I can deconstruct the problem and find a solution. Years ago, I designed a proxy hedge for U.S. college tuition inflation. And the way I did this, there was no easy way to do this, but what I did is I said, well, let's look at how colleges set tuition. And the answer is that colleges set tuition in a pretty simplistic way. They're kind of given the expenses. Expenses are last year's expenses plus 4%. And there's a budgeting process and whatever, but there's not a whole lot. There's not a lot of a lot of efficiency going on. But effectively, that is, essentially the expenses are given. And then you've got, and most of those are salaries. And then you have sort of two sets of revenues. And one of those is tuitions, and one of those is the endowment, or if you're a public institution, you get public funding. But it's easier to think about a private institution. And so what the board does, the way that tuitions are set is we take these expenses and we subtract how the endowment did, and the result is how much we have to get out of tuitions. And so when the endowment does really, really well, tuitions don't go up very much. And when the endowment does really, really poorly, tuitions go up by more. And so it turns out that one way to approach a proxy hedge for tuition inflation is simply to do the opposite of what the endowment is doing. And so you can sort of look at history and see that tuition relative to overall inflation tends to accelerate when the stock market is doing really poorly, and it tends to decelerate when the stock market does really well. So that in fact, the way you should approach to college saving for college tuition is to not just invest in stocks, because if stocks do really well, then tuitions won't go up very much. You actually should underweight stocks a bit. Anyway, I don't mean to get into discussion about college tuition inflation. The point is just that sometimes you have to think for more than 5 minutes and try different models in your head to see how something works. And it's just astonishing to me. I know that most of the people who are listening to this podcast are smarter than the average bear, and so this does not. I'm just griping to people who just didn't really need to hear it, but it is astonishing looking around at how little creativity. And I don't know if that's just because we don't teach it very well, and we just teach people to give the answer in the book. I remember the teacher's notes used to say answers may vary for a lot of things, and maybe they don't say that anymore. Maybe they just say the answer is 4, period. And maybe there's just too much of that. Anyway, anyway, that's my gripe. That's my gripe. So let's get on to the, now we're, 11 minutes into the podcast. Let me get to the actual meat of the podcast. I had I always ask people to send their questions, and it usually takes me a while to get to the questions. But there was one this last week that I decided to get right to, and it's from curmudgeon_Dave on X. And the question was, "Hi, Michael, I have a question that I'd love to hear you address sometime. The Fed has a mandate to provide price stability. I assume that means 0% inflation. If the U.S. were to ever have sustained 0% inflation, what effects, both positive and negative, would it have? Thanks." And that's a great question. And again, at some level, it's a simple question, but when you start to really think about it, it's not that simple of a question. So let's start with price stability, because I think that inflation people know this, but not everyone else knows this. It's not defined anywhere legislatively. The Fed is supposed to have, aim for price stability. What does that mean? And it's not defined. And historically, central banks have said that means 2%. Why do central banks said that? Well, funny story. New Zealand in the late 1980s, New Zealand had fairly high inflation. It was coming down, and New Zealand was one of the first countries to really do inflation targeting. And somebody asked the finance minister on TV, "What does price stability mean?" or something to that effect. And the finance minister kind of off the cuff said, 0 to 1. Somewhere between 0% and 1% inflation is, price stability. And then somebody else a little bit later, commenting on his comment, said, "Well, actually, our price index kind of doesn't measure inflation right. We're kind of off by 1% or so. So really that merely means 2%. And that's how we got 2%. Ever since that time, 2% has been, the de facto target at most central banks around the world, which is insane. That is crazy. That is the amount of, and then ever since then, once we decided on 2, then we came up with arguments for why 2% is the right number and not 0. So why not 0? Well, here's the traditional argument is, if you let inflation be 2% and you want to stimulate the economy by making real rates negative, then you just need to drop official rates to 0% and you'll have negative 2% real rates, 0 minus the 2% inflation. And that's stimulative. According to theory, that stimulates the economy. That's great. But oh my gosh, what if the problem in quotes here, the problem is that if inflation is 0%, there's no way you can get negative real rates. Because if I lower rates to 0, real rates are still just 0. Uh-oh. And if inflation is at negative 2%, then I'm in a doom loop where I have even if I lower rates to 0, I've got 2% real rates. And that contracts the economy, which pushes real rates, pushes prices lower, contracts the economy. And that makes inflation minus 3%. And so real rates then are now 3%. And so that contracts the economy more. And we're in a doom loop. There's nothing the central bank can do because all they can do is push rates to 0. Depression. We have a depression for 20 years until we have a world war. That's the mythology, mostly false, of what happened in the Great Depression is that, well, once we started to have deflation, the Fed was just done. Nothing that could happen. That's not what happened in the Great Depression. But I'm not here to talk about the Great Depression. The point is, it's mostly baloney. And not just because changes in interest rates have no measurable effect on inflation. I wrote wrote a comment on that, wrote a blog post in mid-2023. I'll put a link in the show notes called Enough with Interest Rates Already, because that's another shibboleth that people really like to chase. But it's obviously baloney, because the Fed has all kinds of ways to stimulate inflation. If inflation goes to -2 and they want it to go to 4, they can do that. If they want to stimulate inflation to make real rates negative, that's easy. It's trivially easy. You just print money. Chairman Bernanke talked about having a helicopter that dropped money. Yeah, that will cause inflation. Absolutely. If you want to get inflation, all you have to do is add a 0 to the currency, and you will see nominal prices go up tenfold overnight. It's really quite easy. There's no real trick to producing inflation. Producing just a little inflation is a little trickier. But really there's really no problem. You're not going to get caught in a doom loop, because you can always bring inflation up. Bringing it down is sometimes a little harder. Let's suppose, okay, well, so if you have negative inflation and then maybe the problem is that when the Treasury issues bonds at 0, then you get this problem that you have safe investments that have positive real yields, so animal spirits don't operate. Why buy? Let's suppose you have inflation at -5, and so you buy a Treasury bond and you get a 5% real yield. Well, why would you buy stocks, right? So no animal spirits, stocks go down. Except that if that was the problem, the Treasury could issue bonds at a premium that had negative real yields. These are not hard problems to solve. Heck, thanks to the last decade we've just been through, we have all kinds of neat tricks and all sorts of things we thought were impossible, like negative interest rates, that turn out not to be very difficult. Getting inflation up, it turns out not to be very hard. We just print a boatload of money, and that gets inflation up, and we have very direct, pertinent, recent, real experience that proves that. So the traditional reason for stability being something other than 0, for operational expediency, if you will, isn't real. That those are terrible reasons. It's a bad reason to say that stability is 2%. If I was going to make an argument for why stability might mean something above 0, here's what the argument would be. And I've never heard anyone else articulate this, but this is closer to like a thoughtful response, okay? And the thoughtful response is that, well, prices tend to behave in 2 ways. They tend to drip lower or explode higher. Okay, we know that inflation has long tails to the upside. We know that when the supply of something runs out, its price goes up dramatically. Okay, so prices tend to go down slowly, but prices don't tend to collapse. They tend to go down slowly or up rapidly. Okay, so what that means is that the distribution of prices, the distribution of possible prices for a given good or service is not a normal distribution. Okay, it's skewed to the high side. So if you average a bunch of normal distributions that each have a 0 mean, then you get a 0 average. Some will be above 0, some will be below 0, but it'll all average out to 0. But if you average a bunch of distributions that have long tails to the upside and not much of a tail to the downside, and you have a mean of 0, it means that most prices are declining. You have a bunch of small price declines and a couple of really, really big, large gains. And so you could argue that, all right, well, I don't want most prices declining. If I want most prices to be around 0, then I actually have to target the average, the CPI, something above, a little bit above 0. Which gets into the whole question of whether you should really be targeting average inflation or median inflation. And that's one of the reasons that I talk about median inflation more than average inflation is for precisely that reason. And in fact, you can argue that the normal state of things is not an unchanged price, but a declining price. If you ignore money here, if productivity is advancing, then the price of things should decline over time. Let's look at the long-run change in agricultural product prices. Okay, so in 1959, this is as an example, 1959 corn prices in today's dollars, $24, were about $12.50 a bushel. Of course, they were lower in 1959 dollars, or $1.20 or so. But in today's, if you had to use today's dollars instead of nice 1959 dollars, obviously our dollar today is much weaker. If we had to use today's dollars, it would cost about $12.50 a bushel. Today, the front corn contract is about $4.82. Okay, so the real price of corn has gone down quite a bit. Not unrelatedly, the cereal yield per hectare has gone from about 2,500 kilograms to 8,000 kilograms per hectare in that time frame. And by the way, I wrote an article on that a couple of years ago, and it's actually a really neat article, and I'll have a link to that in the show notes. But it sort of shows that the connection between the declining real price of corn and the increasing yield is actually pretty good. And in the short-term wiggles, are very highly correlated with fertilizer prices. But anyway, but the point is that we've gotten better and better at producing corn. The current dollar price of a bushel of corn has gone from $1.20 to $4.80, but that's because the dollar got 10 times weaker. The price level is 10 times higher than it was in 1959. So the real price of a bushel of corn is cheaper, even though the nominal price went up. Isn't that confusing? So the question is it important that the nominal price of things go up over time? I mean, again, the natural state of things, if we are getting more and more productive, you would think the natural state is that things should be generally going down in price, all else being equal. So, why is it important that prices not fall? Another argument is that since wages are sticky, if the price of things actually falls over time, then this will also cause depression because companies will lose money. They have to pay workers a wage which is rising in terms of the price of the output they're producing. That doesn't strike me as a disaster. If the price is falling because the workers are getting more productive, then them getting paid more makes perfect sense, right? Because they're getting more productive. If there's a minimum wage in nominal space, there's no way to lower wages. That could potentially be an issue. But if the price is falling 1% a year for a particular product, it's just not a big problem. If prices are falling 10% for your product every year, well, that's a big problem, but then it's a big problem, and you don't solve that big problem by printing lots of money so that 10% decline is really zero and everything else goes up 10%. In fact, there is something to keep in mind here, and that is that the overall price index is an average, as I said. This means that even if the Fed aims at 2%, in any given year, there are prices that are falling and prices that are rising faster than 2%. And the world doesn't end. In fact, over the last 15 years, there was almost always at least 10% of the CPI basket that was in deflation, which means that at least 10% of the production that is done for consumers was facing the terrible headwinds of positive real interest rates, even though during the 2010 to 2020 period, nominal rates were so low. Those terrible industries where prices were falling had these terrible positive real yields. Oh, no. So what? So back to Dave's question. If the U.S. were ever to have sustained 0% inflation, what effect would it have? So given that background that I've just discussed, let's go back and let's reason this through. First of all, let's stipulate, well, what if 0% inflation meant that the price of every good and service never changed? Okay, 0% inflation, but there's no up and down. It's just everything has 0% inflation. Well, that can't happen. Okay, and there's a reason that can't happen, because if it did, then when consumer tastes changed, there would be no price signal to tell producers to produce more of good X and less of good Y. The price price change is good. The price change provides signals to producers and for that matter to consumers, but it provides signals to producers which goods they need to produce more of, right? So if we just say the average price change is zero, then a price that goes, so if we just said overall the economy now, let's just say the average price is zero rather than all price changes are zero. So the average price change is zero. Then that means that when you look around the economy and you see a price going up, it means more demand than supply, and a price going down means more supply than demand. So that business I mentioned before where prices are falling 10% a year and it's a big problem, well, it's the big problem then is either that you're getting massively more productive and overproducing, which doesn't strike me as all that big a problem unless you're one of the high-cost producers that's going to be squeezed out, or the demand is very bad for your product, which is a problem. It's pretty easy to tell which of those two things is true if you're a producer, right? I mean, whether there's, no demand or way too much supply. But in either case, high real rates aren't really a problem. You shouldn't be borrowing a lot in either case. Okay, either your market's going away, demand's really bad, or there's way too much production as it is, so why are you borrowing? Okay? What if prices are rising a lot for your particular product? Well, then that either means that demand is great or supply is seriously constrained. And fortunately for you, you face deeply negative real rates. And that's great because in either case, you need to borrow a lot to expand output. And so the fact that the price is going up or the price is going down, that signal also presents you with the real rates you need in that industry. Okay? So, in other words, in individual markets where the prices are actually determined away from the Fed, real interest rates in terms of the output of the product send very clear signals, and that's really, really important. In the overall economy, where the average inflation rate is zero, well, if the Fed really wants to, stimulate output broadly, then it certainly is more difficult in that case because it's going to end up, stimulating some industries that don't really need to be stimulated. They need to not be borrowing. But in order to stimulate the entire economy, you need to stimulate those that were having problems, right? So the industries that need low real interest rates have them, and the industries that face high real interest rates do so for a reason if the overall level of inflation is zero. The real question then is if we need to have inflation above zero because the Fed needs to be able to stimulate. Wait, why should the Fed be stimulating the overall economy? Who made them boss? And that's the real question, is that you only need to aim for a positive inflation rate that allows you to have negative real yields if it is important to you that the central bank is able to monkey with growth and stimulate it and keep you from ever having a recession. In my opinion, recessions serve functions. Expansions serve a function. And it's all of those are okay. And so I think that if the Fed decided to focus solely on its price stability mandate and just try to get the average or median price to be unchanged and abandoned its more fun goal of screwing with interest rates to make sure the economy didn't contract when it needed to, it would be fine. And your money wouldn't lose value automatically over time, which would be a good thing. What would the bad effects be? Well, the only bad effects I can see with that, it would make it more difficult for the central bank to do things that, frankly, a central bank shouldn't really be doing because they're not very good at it. By the way, in conclusion, this is actually less important than it once was because the Fed now engages in flexible average inflation targeting, FAIT, which allows it to be flexible in hitting that 2% target. And so it's not committed to hit it at any given time. It's it's very similar to your teenage daughter having a flexible curfew so that she just needs to be home at 10 p.m. on average. If you leave it flexible, guess what side you'll tend to miss curfew on? You'll tend to be late to curfew a whole bunch of times. Dad, it's okay. On average, I'm going to be home at 10 p.m. I don't think it works in that case, and I don't think it really works in the Fed's case either. But anyway, that's all for today's podcast. Hope you enjoyed it. Please like and subscribe and refer others. You can contact me on X at inflation_guy, as Curmudgeon Dave did, or you can contact me by writing to inflationguy@enduringinvestments.com. The blog is at inflationguy.blog, and visit Enduring Investments if you need help with diagnosing or treating any inflation-related problem you have. But most importantly, defend your money. And if inflation is coming for you, remember, you know a guy.